I'm Ross Mayfield, investment strategy analyst at Baird, and we're back for another weekly video with our friends at Strategas. I'm thrilled to be joined today by investment strategist Ryan Grabinski. Ryan, how are you doing today?
I'm doing well, Ross. Glad to be back.
Yeah, good to have you back. And like probably last time we had you, we're here to talk about the Strategas market balance sheet, which then informs our Baird market gauge. It's an exercise you all do where you take 16 kind of building blocks of equity markets in the economy and put them in, an asset or liability camp. Are they good or are they bad right now? You all made one change this iteration, which was to downgrade the administration category. And I'm just going to turn it over to you if you could talk us through kind of the thinking there and what informed that decision.
Yeah, absolutely. So, as you mentioned, our latest iteration, we downgraded the administration. The reason really for doing this is because it'll be more aligned with the fiscal health category, which was also a liability. And we're also taking into account all the hand-wringing that we're seeing constantly in Washington, which is ultimately creating some uncertainty for investors. We all know that the Democrats have control of the White House and Congress, and therefore have the tools available to enact their policy priorities. But with the slim majorities that they're holding, it's allowing the moderates to pare back some of Biden's fiscal agenda. Obviously, they're still negotiating the social infrastructure package to pass through the reconciliation process. This will likely include tax increases. There's still some jury out on what those tax increases will be, so we're not going to speculate at the moment. But ultimately, the proposal has been reduced in size pretty significantly. As a lot of these Democrats are concerned about the amount of spending and tax increases and the risk that the proposal potentially places on their political futures in 2022. The large or poorly targeted tax increases could ultimately be viewed as a policy mistake. Furthermore, obviously, there's still a need for Biden to appoint some key members, which would likely bring some more regulation overall, which is never great for companies as it increases their costs.
Yeah, absolutely. And I think that's a good point. As you mentioned, kind of the challenges of passing legislation, the other lever they can pull is personnel. And as you know, that kind of informs policy and certainly regulation. Let's shift to the other topic that we can't quit talking about, which is inflation, stagflation chatter. You all have actually done some interesting work showing that, we're kind of at like peak stagflation talk. It's being mentioned a lot more in the news. But with all that said, price stability inflation is still a liability by this framework. Could you talk through that briefly, and then maybe what you might want to see to see it shift to an asset at some point in the future?
Sure. So, obviously, we're of the view that inflation is going to be less transitory. I think that's become more and more consensus on the street now. We're not going to say that inflation is going to be like the 1970s, but we see it more as a question: are we going to enter a regime where inflation is called in the 3 to 4% range, whereas over the last 10 years prior to COVID, we're sort of in that 1.5 to 2% range. Obviously, we care about this from a market perspective because historically we've seen investors pay lower multiples for stocks as inflation rises. I think one of the things we could we'd ultimately be watching for to sort of shift it to back to an asset would be sort of a stabilization in the readings. I know we've had 4 or 5 readings of greater than 5% on a year-over-year basis, but we'd ultimately want to see those start to come back down before we ultimately made the shift. Obviously, it's going to take some of the supply chains, the logistics issues to resolve themselves before we think this will happen. Where we have significant labor shortages, and ultimately that's going to put pressure on wages in at least in the near term.
Well, let's end on a positive. You mentioned supply chains, and we're in the middle of an earnings season. Corporate commentary is littered with talk about supply chain pressures and inflationary pressures, but nevertheless, the results have been pretty solid so far, bolstered by very robust demand across industry. Corporate profits and profit margins remain an asset by this framework. Could you talk about what you're seeing this earnings season and why you think that's still positive?
Yeah, absolutely. So obviously, we're only about 40% through the third quarter earnings season, but thus far we have about 80% of companies beating analyst estimates. This figure is actually slightly down from where it was during the 1Q and 2Q reporting seasons, but is still well above its long-term average of about 66%. Earnings growth this quarter and while it's still early, has improved to 38%, which is up pretty significantly from the original estimate on October 1st of about 29%. I think I will say I am getting a little more cautious on what I'm seeing in the second half. We're starting to see some of these estimates actually come down in 3Q, and some of that's just because earnings have been so strong thus far. But there's two sectors in particular that we're watching. It's technology and communications. Obviously, we're going to be keeping an eye on that to see if that changes as we get some of these larger companies to report earnings. As far as the margin story goes, it's actually been pretty remarkable. Since the recovery from March of 2020, they basically have continued to touch all-time highs. At some point, we think higher labor costs, higher input costs, and the potential softening of sales will ultimately hit them. But we just haven't seen that point yet.
Yeah, and remarkable is definitely the way to say it. I mean, these companies have a lot of levers they've pulled, and to great success so far. So we'll keep an eye on it. I know we're only halfway through earnings season, so we'll look forward to more commentary from you and the team. And as always, we appreciate you jumping on with us.
Thanks a lot, Ross.
Thanks.